Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, in the same regard, our upside is $1.15 up to 23. So between now and June, the investor is guaranteed of exiting the stock at $21 if wrong. So if natural gas starts collapsing and the ETF goes from 21 down to 20, down to 19, down to 18, doesn't matter. You're exercising the put option and exiting your entire ETF position at $21. Your risk has been completely mitigated and limited to the 85 cents. But now you have the upside of the stock to 23, and even if the stock reaches $23, you can always do what's called a roll up and out on the strike price to continue to participate on the upside of the ETF. Now, what this has done is reduce the cost of the protection at the expense of the upside, and that's what's called the hedge wrap. Now, some people just want to buy the put protection and not cut off any of the upside, which is perfectly fine, but recognizes that when you start becoming a very large investor, let's say you're putting $1 million into this ETF, well, now what happens is to go out and spend, let's say, $50,000 on buying put protection seems expensive because you're thinking, what else can I do with $50,000? Well, I could buy myself a brand new car, or I can do any or a number of different things. Paying $50,000 for put insurance becomes a very expensive proposition. But now, if you can reduce the cost of that $50,000 protection by having collected $25,000 in income, what you've done is now reduce the cost of that insurance, making it a much better proposition. So in summary, to kind of discuss that, and by the way, now people can start typing in any questions that one may have for me as I wrap up this here over the next 5 minutes. I'll start addressing any questions in there. But to just summarize everything in here, spreads allow smaller accounts to achieve greater leverage if desired. Understand, and I always emphasize this to all of our option source students or any of our members that are a part of our programs, is the fact that leverage is a double-edged sword. And while it certainly allows smaller investors to achieve really great returns, it, in the same regard, at the same time also means that you could lose money at a faster pace when you leverage, and so leverage is a double-edged sword. But if you are desiring or seeking a leverage to enhance your returns, spreads allow you to do that. Now, debit spreads create volatility neutral directional plays. So when you want to get into like what we do at Option Sources, direct market forecasting, we believe, like for instance this morning, we were selling a whole series of options into the volatility spike and trying to profit from the fact that the market was really cheap and was paying a big premium. We were option sellers this morning, but as a whole, if you wanted to, let's say, make a directional play and profit from the market selling at those lows, one would open a debit spread to make it a volatility neutral strategy. In the same regard, credit spreads allow you to create income without the larger margin requirements of naked writing, and collars mitigate, especially in high volatility periods where put protection becomes very expensive because of high volatility. The collar, by selling the cover call, reduces the cost of buying that put protection at the expense, of course, of some of only limited upside potential. But like for instance, over about 2-3 weeks ago, actually for about 6 weeks in a row, during the month of February going into March, I was just beating the drum over and over again. Create collars on it. And so many of our traders have been long stock and have been making so much money on the upside, and these investors are too stubborn to want to sell their stocks because they're sitting on such big profits. In the end, we're saying you got to collar that. you have to turn around and buy some put protection to lock in the sale price of your stock, and sell covered calls on the upside to actually pay for that put protection. And that's something everyone needs to learn. So I'm going to take some questions, but I want to invite everyone over to visit one of our free workshops. Our workshops are not sales events. They're actual 1-hour workshops where we look at the markets and actually teach you valuable strategies the way we were today that one can actually utilize in there. So I encourage everyone to go there. We have great option calculators, strategy guides on there, and anyone that attends the workshop can also actually request at the same time complimentary access to our Option Source website, where we all give our trade alerts, market forecasts, all sorts of really great content. And we give access to that, but one has to actually attend the workshop to request one of those. But I encourage everyone to visit our website to learn more about that. But with that said, I'll start looking at some of these questions online here. Steve, if you have any comments or anything you want along the way, I don't mind going back and forth during the question and answer session on anything here. So if any time you want to come in and join me, you can. But I'm just going to read some of these questions. So if you guys just give me a moment, I'm just going to read it and then answer them as we go here.
Patrick, I have a question for you, Steve.
Oh, sure. Go ahead.
Do you think it's an incremental process to callers? Is that the way you teach it, meaning that you start off with an investor that is comfortable with covered calls and then might branch into the put, which of course makes it the collar, or is it someone that buys a stock and owns a put, and just in your experience, and then you sort of encourage them, hey, you might want to sell a call, like you said, that, you know, if you have a large portfolio, even a small portfolio, the price of insurance is expensive. So how do you see it at Option Source?
Well, at Option Source, first and foremost, we hate losing money. And in that process, we look at options as a tool. And when you look at an option as a tool, what we're always trying to do is find ways of removing the risk of being long equity, while we still don't want to, while still having the upside potential. And this is a very powerful thing. And so what we always look at it, we do look at it from an incremental perspective, but we also look at it from a pure strategy. So in our hedge directional trades part of our website for our alerts, we'll actually make a directional call. Let's say we had a spider debit spread open on the downside for between the 132 to 127 level to forecasting this market correction. We took profits on it today, right at the market, right as the market opened down at that level. The spider was trading below there. That was a debit spread that way, but a collar we would actually open in some cases in combination with a stock that we may have already been in. So we may have, let's say, watched the stock rally and work its way higher, and suddenly we say, God, you know what, let's not look the gift horse in the mouth and say, look, we made some good money. We might continue to make money, but let's not give any of it back. So at that point, locking in the gains with a protective put on one of our long stock positions is really good. But at the same regard, to pay a huge put premium to lock in the sale price, we want to mitigate the cost of that. And so selling the covered call and leaving a little bit of upside on the position to keep making money on the upside, at that point, that probability of the stock continuing much higher is not remotely as high as it was after the rally has occurred. So cutting off the upside is always not a bad thing at some point when the rally gets really long in the tooth, and then offsetting the cost of the put protection with the covered call. And that's a powerful thing. And we talk about these strategies all the time in our workshops. Those free workshops that are on optionsource.net, we give real education, and that's not a sales promo. It's actually real content, and it's very valuable for people to learn it that way. And so I hope that answers your question. There's a question here from someone asking about back spreads. Back spreads are a great way of actually profiting from contraction and volatility. And we never covered them today, but we do talk about back spreads in our programs, and there are times when you can certainly utilize that. There's just a question here. Just let me see here. Can you suggest a tool if the price of a given ETF spread was too high or too low to determine whether to buy or sell spread? I would actually first look at what the situation is with a particular ETF and then determine whether you're better off just buying the option outright for a directional call, or whether you're better off to actually offset the cost with a spread. I don't go into a position saying I only do spreads. My first strategy is, what is my forecast on this ETF? And then I determine what is the current state of those options. If I find that those options are simply too expensive, we immediately have to turn to spreads as one of the ways of mitigating the cost of that. But there's more often than not, we might just use an outright call or a put option to profit because the option was cheap enough and our market forecast was far enough out where we knew we could profit on it without having to offset it in a spread. So I don't ever want to just pigeonhole us to saying we only do the spread and we're looking for at this particular moment. We have to look at it in the context of our market forecast. And you almost want to look at each option strategy as a different weapon in your arsenal of tools when you're trading. And you want to know, whatever the state of the market is, what tool or what combination will allow me to profit from the current state of this market. To always say, I only do, let's say, cash covered puts, I only do covered calls. What you're doing is you're pigeonholing yourself to one strategy, which is not ideal, let's say half the time. Half the time covered call writing is a bad proposition because there's too much downside risk and not enough profit in the actual covered call exercise. At that moment, doing bear call spreads becomes valuable because then you're not being hurt by a market pullback while you're generating income. It's very important to know how to utilize these tools. And at Option Source, our focus is 100% on training traders to know how to navigate these types of markets and make money. It's not supposed to be complex, even though for a beginner it seems like all of these different things can become overwhelming. But understand, it all makes sense when you start to realize what we're really doing is simply trying to profit from a particular market forecast. And we're putting together a combination of options that most effectively will profit from the actual directional call. Let me just keep reading the questions here. Bill, to answer your question in terms of a collar trade, do you recommend using the same expiration date for the call and the put? That is, again, not a right or wrong answer. There are certain situations where doing a calendar collar hedge wrap is certainly effective, but again, it has to be unique to that circumstance. It's not something, again, that I would say is a right or wrong answer. If I'm doing a direct hedge to lock in profits, I'll more often stay at the same strike. But there are certainly times, especially for beginning new positions, if you open immediately as a collar, where doing a calendar spread on the collar is a fabulous strategy. Steve, did you have any other questions or anything that you wanted to?
Yeah, one other question, Patrick, and I get this question very often. What happens when you underestimate a trend? So you put the collar on in FCG or whichever one, and let's just say that we put it on as 21 and we do the 2022 or something like that. Next thing you know, we're wrong, which we want to be, of course, and FCG is much higher. What do you, because I know that you teach so many investors, what do you do for the investor that gets angry about selling that option now that it's in the money? Do you advocate rolling? How do you handle that?
Again, that all depends. First of all, we don't like to involve emotions In the end, we make a very specific call, and if it passes that strike price, we are profitable. And we knew when we opened the trade what our maximum profit was. And if the stock's above that strike, well, we're making our maximum profit, but that was a profit we were looking for in the first place. What a lot of the beginning traders do is they chase, which is that they feel compelled. I'll give an example. One stock that I know some investors were chasing was, let's say, First Solar. And as that stock was rallying higher, they capped their upside at the $145 strike. The stock was running up to 165 in a very rapid kind of fashion. And these traders were saying, "Oh, I'm missing out," and they cover the call. And then the stock turns around and drops back below 145 only a week later. And what happens is that a lot of traders misinterpret the volatility of the market and give themselves too much credit for being market timers when they're actually not very good at it. What more often than not, it's better to honor your trade and just accept the spread for what it is. And not roll it. But you could always, if you do choose to roll the what we call up and out, where let's say you're at the $23 covered call, and suddenly it rallies to 23, just as it's at the strike, you can always go roll up and out to a $24 strike, let's say a couple months out later, wash out the premium, and now have upside up to 24. But I usually don't recommend that unless there's a unique circumstance that you really should capitalize on. But that's not something we regularly do.
Great answer. Great answer. Patrick, why don't you see if you can wrap up, see if there's any other questions you'd like to answer.
No, that looks like I answered most of the questions on there. So, yeah, this webinar was recorded. I don't know if that was one thing you were going to mention in there, so anyone can, I think, watch that in the ISC archives. And again, I hope everyone takes the opportunity to visit our site at optionsource.net and register for our workshops. We give them twice a week. Every week, so I hope you guys take the opportunity to join us, and we'll look at some different real positions and some different things that one could profit from, and you can learn more about what we do at Option Source and how we do it. But with that said, thank you everyone for joining us, and it's all yours, Steve. Thank you.
Patrick, thank you so much. I can't urge you enough. Patrick just tried to, well, firstly, did a great presentation, tremendous. But please take him up on it. He and Jason, they offer webinars, as he mentioned. Let me just go back to that. Free webinars, so there's no commitment. They do them twice a week. So go to optionsource.net and try to sign up for one of those free webinars. No commitment. Why not? And Patrick and Jason do such a great job in educating investors. Why not learn more? So I want to thank Patrick, as he did a great job today discussing the spread strategies for trading ETFs. You know, whether you're trading an ETF, an index, or even an equity, most of the methodology is the same, risk and reward. And Patrick did a great job in talking about the mitigation of volatility risk. That is a primary part of the risk of owning an option, even selling an option. And I think he just hit the nail on the head. Patrick, thanks again for the great
Thank you very much. All right. Have a great afternoon or evening, everyone. Thank you very much.
You too. Just want to remind everyone, next week we have Pro Market Advisors with us. They'll be talking about other strategies rather than just call buying. Then the following week we have Andrew Hart talking about 10 steps to create an effective trading system using ETFs. Then we have Mike Tusaw talking about correlation. So we have some great webinars coming up. Please catch us again next Tuesday, 4:30 Eastern Time. Sign up if you haven't already signed up. And also catch the archives. Whether it's Patrick or any of the other guests, they're all archived. Please circle back to the ISC and listen to the presentation again, whether it's on iTunes, podcast, whatever you'd like. They're all available. Thanks again. Just want to thank Patrick Seresna for a tremendous presentation. I want to thank all of you, the attendees, for making it such a great presentation, great questions. Make the presentation. Thanks again. On behalf of the ISC, it's Steve Meisinger, wishing you a safe and happy trading day tomorrow. Good night, all.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.